have some of the biggest names in capital markets up here. I don't think they need much of an introduction. So I think we're going to do something a little bit different today. You know, I think it'd be interesting for the audience if we went down the row and you guys talked a little bit about what you guys do on a daily basis. You all have big jobs. You're all in shipping capital markets. You add a lot of value. You know, how do you differentiate yourself in your offerings, what you do, your approach? You know, Jay, you're with DNB. Why don't you start us out?
Sure, Keith. Great to be with everyone today. Happy to give a quick intro. My name is Kwon. I'm with DNB Markets. I've been with DNB for since 2011, so going on 13 plus years, and prior to that I was at the UBS. I guess in terms of DNB, I think one thing I can share is that we do have quite a niche focus around shipping, energy, offshore, and that's I think we take a lot of pride in the sector that we focus on, and I think the clients really appreciate that we understand their business well. And so we have quite a collaborative culture. We have colleagues we work very closely with in London, Oslo, and Singapore. And so when you hear about a lot of cross-border trades happening or new financings happening, whether it's in the equity or the bond markets, whether it's in the US or Norway, it's because we're able to work across various time zones and also have a lot of relationships across both investor base as well as clients that we cover as well. So quick summary of DNB, but nice to be here with everyone.
Good afternoon. My name is Wilhelm Gedde-Dahl. I'm head of shipping on the investment banking team of Fearnley Securities. I've been with Fearnley Securities for 12 years, all those 12 years on the investment banking team. Fearnley Securities is part of the Astrup Fearnley Group, which is a global leader in ship brokerage. And naturally, Fearnley Securities focuses on the maritime and offshore sectors. To your question, Keith, I think what's really a big focus with us these days is to work together with our ship broking colleagues to advise and facilitate good ideas within what is also a topic for this panel, M&A in an environment that's quite rewarding for M&A these days.
Wiley?
Wiley Griffiths. I run our global transportation group at Morgan Stanley, which is basically coverage of shipping, airlines, railroads, that type of thing. As some of you know, I spent the formative part of my career, I've been at Morgan Stanley for 24 years, doing just shipping, kind of in the early 2000s to the late 20-teens, when things were super, super busy. And Morgan Stanley is a full-service broker-dealer, investment bank, and really the best on the street when it comes to distributing equity capital and M&A especially, although it's good across products. It's also spent a lot of time building up its platform more broadly, so outside of investment banking, investment management with acquisitions like E-Trade, and wealth management with acquisitions like Dean Witter and Smith Barney over the years. So we think about shipping as broad coverage. My job is to make shipping relevant to Morgan Stanley internally so that we direct and harness the power of the firm when we go to do an equity deal or a debt deal or focus on advisory. And I would say my job has changed in that the relevance of a Morgan Stanley in the shipping arena is, I think, more targeted to the existing public companies, new potential IPOs, it's very deliberate and selective in terms of those candidates, and then some of the M&A advisory that's going on, for example, in the LNG space as financial sponsors and infrastructure funds start to expand their definition of infrastructure. I'll stop there.
Now, Ulla, you're sort of the odd duck up here.
So these are the dealers. I'm the user.
So when you're not roughing up these bankers, as a CEO of a major diversified, shipping company, how are you spending your days these days?
Yeah, so Hjertaker, CEO of SFL Corporation, a maritime infrastructure company owning, 80 plus assets, predominantly a lot of liners, but also tankers, bulkers, you know, we have car carriers, and a couple of drilling rigs. So we have been, you know, quite active in the market over the years. I'm also, you know, affiliated with Frontline on the board there. So we did a sizable M&A transaction last year, where, you know, some of you benefited here on the hair up here. So and what we've been doing, we've been using the markets both in the U.S. and in Europe, and predominantly Oslo, over the years, and it's quite interesting to see how different these markets are, both in terms of size of the deals you can do, but not least also the complexity of doing deals and the costs associated with it, because that's like a night and day between the markets. But I'm sure you're gonna dive more into that, Keith.
Absolutely. Well, I think, you know, to sort of lay the foundation for this panel, you know, it'd be helpful to get an overview of the capital markets generally. You know, we've heard on some of the other panels, obviously there's uncertainty with the election. You know, there's a changing rate environment, uncertain geopolitical risks. You know, Wiley, maybe you could start us out from a U.S. perspective, give us an overview of how the capital markets are shaping up. You know, what are you seeing, and sort of, you know, lay that out for us.
Yeah, so from a broad perspective, the capital markets, despite a lot of the, you know, kind of geopolitical and broader uncertainties, has been the strongest it's been in probably 3 years. As a full-service investment bank, IPOs were effectively, that market was shut most of 22 and 23, opened up again in the spring of this year. Despite higher rates, I think the fact that there is monetary policy seems to be working. There is a certain seasoning in the market, and issuers are still active. So we're seeing everything from LBOs to regular way refinancings to opportunistic refinancings in the debt market, and M&A has been steady kind of over the course of the last 3 years. So I would say we're in a place where the capital markets have been functioning during a time when not all of those financing products, if you will, were available. And to give you a sense, I would say the large U.S. banks are probably up 30 to 60% in terms of their capital markets business this year, year over year.
Well, and maybe you want to talk a little bit about the Norwegian market, maybe give a little bit of a European perspective, and anything you want to add on to Wiley would be great.
Absolutely. In Norway, the sort of flavor of the week is the bond market. So it has been mentioned on previous panels, but that's where we are seeing the biggest activity at the moment. Shipping companies and energy and related companies issuing bonds. We have seen underlying interest rates come down. We've seen margins come down. So we are in an environment where the sort of spread to secured bank loan has never been narrower, which has, of course, intrigued issuers and led them to tap the market. This has happened together with investors being quite interested in investing. There have overall been more redemptions in the Norwegian market over the last few years than issues. So the investors are quite abundant with cash and looking for investment opportunities, which has resulted in what we're seeing at the moment. On the equity capital market side, I think things are at the moment a little bit sort of sideways, a little bit wait and see attitude. Share prices peaked back in May on a very, very strong sentiment and then came down over the summer. Going into what is a seasonally strong quarter, expectations have been high, and maybe at the moment expectations are not completely met. So as we have seen over the last week, share prices are tumbling a little bit and moving further down from the May peak. So a little bit wait and see in the ECM markets. Also want to mention IPOs. We know that shipping IPOs in Norway has been easier to conclude compared to the US. The hurdle is a bit bigger in the US than in Norway. Last IPO now in Oslo was back in March last year, a small chemical tanker company called Stanley Tankers. So yeah, a little bit of a sort of stop also in the IPO activity. Having said that, I don't think it needs much more than a strong Q4, which still can materialize. Share prices closing the gap on NAVs before the Norwegian market can start to see some shipping IPOs again.
Thanks for that. So I kind of want to shift gears a little bit and talk about, whether shipping companies are setting themselves up to be attractive for investment. Shipping companies have been making a lot of money for a long time now. They're not making quite as much money as they did in the recent past, but still the market's good. Ulla, as you think about capital allocation, how to deploy your money, you obviously paid a dividend since 2004. You've had a lot of long-term success. You've been listed over 20 years. Talk to us a little bit about how you want to spend your money, who's going to be the big winner, what do they need to do, and what are you doing to achieve that?
Yeah, I mean, how we're spending the money, that's very easy. We're buying infrastructure assets and offer it to, very strong counterparties. Right now, most of our portfolio is with investment-grade counterparties, which has a very different sort of risk profile. But so we are maybe a little bit unusual in the maritime space, also from a shareholder perspective. If you look at our shareholder base, we have John Fredriksen with around 20%. We have around 35% funds who file their holdings with an average hold period of around 10 years or so. Which is quite different than what you would expect in shipping, which is more of a hedge fund, private equity type market with relatively, I would say, sort of quicker money. They want to double their money in 12 to 24 months and then get out again. And this is unfortunately down to the history and the structure of the market. Remember, shipping is really, moving raw material from one place to another, and it's been over time, it's been structurally, the ship owners have structurally been doing it to themselves. Typically in a strong market, you run out, order many vessels. As the vessels get delivered, you get a depressed market, you lose money, and then you hope that you will live through the down cycle. So right now, for the first time in as long as I can remember, we have a very strong market in virtually all segments. And this is partly due to the supply crunch, where the shipyard capacity has been cut around 50% over the last 10, 12 years. So it will take time to, even if you want to, overflow the market with asset, it takes time. But the old history, the boom bust, and there are a couple of pretty high profile, very horrible performance in the shipping space as listed entities. So it takes time to rebuild confidence with investors in terms of finding, in terms of bringing investors into what many think is a bit of an obscure little segment. And some of you guys, I mean, you look at not only shipping, you also look wider at other transportation, call it modes. So do you see the same characteristics there, or is it different?
I mean, in terms of transportation verticals, it's very similar. I think the differentiating piece is, if it is a service, is there a contract related to it? And that's your business model is very much predicated on contracts, but everything else is, as in most things in the world, supply and demand. And at some point, whether it's too many airplanes in the U.S. Bringing rates down, et cetera, the good times come to an end.
Yeah, I think there's definitely been, I think certain sectors have benefited more than others, as you know, Ole, and I think this has also given rise to a lot of new funds, frankly, that would never have looked at the sector, like LNG as an example, where I think we have seen more and more interest in that space because of contracted nature of many of these contracts. And so I think we're definitely in a very strong, it's pretty remarkable to me how strong the shipping market has been the last couple of years. I don't think anyone ever expected this, and I think, Keith, to your question about what companies are doing right now, I think most companies are trying to figure out, how do I reward shareholders and do it in a prudent way? And whether it's through special dividends or buybacks, there are companies who are taking advantage of getting bigger, like BW LPG, buying the BLGC fleet from Avant, and you mentioned, Ole, obviously the Euronav CMB deal. So I think you're seeing companies trying to assess where they want to be in terms of size and also in terms of capital return policy right now. And I think that's probably one of the key decisions I think most companies are facing right now.
Wilhelm, what would you add to that?
Not that involved in other transportation businesses, Keith, but one similarity to other sectors that cross my team's desk is the offshore sector. And I think that's quite similar to shipping in that the investors are trying to time the cycle and come in at the bottom of the cycle. And offshore is just a couple of years behind shipping in that respect, and have been a quite busy segment for Fearnley over the last couple of years, where the sort of equity story has been to buy cheap and, as Ole said, as a hedge fund, try to double your money in a short time frame. So no, so the investors want that risky and high return exposure, as opposed to maybe other transportation sectors where the contracts are more important.
And maybe also adding to that, one of the issues we have in the or in the shipping space is this obsession with NAV, net asset value or broker values, which has an impact on the willingness to raise capital and what price you want to raise it at. And it's also a little obstacle to do M&A, because even if you're priced at 60% of NAV, in whatever segment you are, you will not sell your company at 80%, which is, a significant uplift from where you're trading, because you think that it's got a different value. And what we have to remember is that this NAV, steel value, those numbers are set by brokers who have a completely different agenda. They really just want to get a shipbroking trade done. That's how they make the money. So of course, you have Fearnley's here, on the panel. I mean, you do it yourself. I'm sure you can talk to the shipbroker and nudge them on the number you want to get. But that is really an obstacle. And we've also seen over time that many companies are consistently priced below this NAV, and other companies are consistently priced above NAV, which is also, to me, a signal from investors that they value companies that have a investor-focused approach, and penalize the companies who, where there may be fee structures or other issues that is holding back willingness to pay up for the stock.
Well, Ola, let's stay on this NAV theme. When we think about opportunistic capital raising, you enlisted the help of the other people, on this table to do a capital raise in July. You were able to target the market, do an opportunistic raise. You went out into Norway shortly thereafter, raised more money there. Talk to us about what conditions need to exist to do these opportunistic raises, and why were those the right times to raise money for you in those locations?
Yeah, of course, every transaction has its own history and sort of reasoning. I think, we've done, 16 bond loans now. A couple of them in the U.S., a couple in it's sort of in Norway. It's more Scandinavia, Europe, but it's based on the Norwegian documentation, which has its own, stuff here. So you could say that's, back to the, whether that's what some compare doing bond loans to taking drugs. Once you start, you're difficult to stop. So you keep going. But joking aside, the thing there, and this is maybe also a, difference between the U.S. market and more Scandinavian, Norwegian market. In that market, you can do $100 million. That's fine. That's good. That's a decent size. You get decent liquidity. If you go to the U.S. market, do a bond loan, you need to raise $400 million. So, and what that means is that if you are there and you're doing a program, right now we have 5 or 6 bonds outstanding. We have like $500-600 million. If you multiply that by 4, you really need to have a bigger balance sheet to manage that, because bonds is only one part of your cap structure. You have to balance that with, bank debt and equity, etc. So even Frontline, which is the largest sort of traditional shipping company listed out there, $5 billion market cap, is really on the small side to be an active player in the US bond market. And that is beside, and then the whole cost of, feature of it is of course another side to it, but it's a much deeper market, but it's not really that available for our industry, unfortunately.
Wiley, what conditions do you think need to be there?
Yeah, I mean, I think the capital markets for shipping have always been pretty window driven. And so I think what investors like to get involved in is some exposure to something that's got some runway, that has some alpha, in other words, is outperforming other parts of the market. And what we've seen in shipping historically has been supply conditions lining up where you feel like you've got a year or two where things will be balanced at least, and you can have some upside on the rate environment, potentially, as Jay said, some return of capital opportunities. So I think right now, as Ola pointed out, the businesses are performing relatively well, and the supply conditions in most sectors are pretty good. And so investors are interested. I think there's a market there. The market is, from a cost perspective, whether it was SFL or Dorian, good because the window's open, but historically kind of in and around what a discount to last trade that we've seen shipping equity deals line up at. And I think that cost represents the fact that those are the first couple of real primary deals we've seen in a while. So to your point about what are you going to spend the money on, or when asset prices are really high, I think they're giving to the highest quality companies that discretion on capital allocation. And so I think the conditions are related to the issuer, related to the state of the part of the industry they're in, and then I think just kind of overall health barometer of the equity capital markets, which has been better this year.
Well, Wiley mentioned there's been only a few raises here, markets that are all-time high, bond markets on fire, a lot of activity in Norway. Has the U.S. gotten too expensive for shipping companies to raise capital here? Or
I'm never going to say yes to that. I think what we're seeing among some of the U.S. listed names is, more consolidation, but we're also seeing a bid in the private markets. For example, TK LNG, Stonepeak, and Gaslog and Levanos BlackRock. People are interested in the industry. I think, to Ola's point, when the hedge funds were really into it, when there was real alpha during the China build and the MLP era and some of those kind of unique periods, I think you got a lot of fast money in there. And I think right now what you see is more balanced shareholder lists of shipping companies, and so what I'd call more regular way capital raises. And I think the U.S. is just a little different. To Ola's point, like the bond market, the equity market here is super, super deep, but it becomes a bit of a scale issue.
Yeah, just adding to that, I think it's important to remember that the extremely strong markets that we have seen started really after the pandemic, with the container market first and the dry bulk market, and then you also had even the car carriers, which I'm sure most of you never heard about a couple of years ago. Really saw strong rates, which also resulted in a couple of car carrier IPOs in Norway. This period of fantastic earnings and as a result appreciating asset values and share prices was really what everyone was expecting or waiting for after the financial crisis. So call it from 2008 up until the pandemic, we had a lot of false starts and only very few theme-based windows in the capital markets for shipping IPOs, which sort of never resulted in a sustained upcycle. But what has happened after the pandemic is really a sustained upcycle, and it's much easier to get investors' attention for an interesting shipping opportunity on the back of what has happened over the last few years. What's the problem, I think, except for right now when there's a little bit of weakening in share prices and stocks trading below NAV, etc., is that you need to have a unique opportunity to go to the stock markets. There's no point coming with a company that's sort of already listed, where the investors can get the same exposure in a larger and more liquid name. So that's an important thing to remember, and which we spend quite a lot of time on discussing with our clients who are private companies and want to list.
Anything to add, Jay?
No, I think that's a good summary.
You know, Wiley brought up that he's seeing a balanced book of investors, investing in shipping companies. Jay, maybe you could start us out and talk a little bit about who's investing, who's interested, what are they interested, what are they looking for? Talk about the investor.
Sure. I guess probably where we've spent most of our time actually is more with funds, probably less so than in terms of, if you sort of bifurcate it between equity and debt. But I would say we probably spend more than half our time, and I know Wiley and I are working on another trade right now, but I'd say more than half my time is with funds that like the space. It's been great to see the space really rebound over the last couple of years, and I think you're seeing greater interest in the space given the size and and again, going back to contracts and cash flows, I think, which are very important for a lot of these funds. So I would say that there's been quite a bit of increased interest and appetite from funds that look to this space and feel that they can earn an appropriate return of capital with certain risk adjusted for the type of investment we're talking about. So I would say that we're seeing more and more new funds coming in. I think on the equity side, there just hasn't been a lot of equity trades. There's been a few secondary trades, which, the Navigator trade with BW was very successful. And, that was, new investors coming in, new equity investors coming in, both hedge funds and long only. But there just hasn't been a lot of need for equity because most of the companies are doing so well and really are thinking about capital allocation policies I mentioned earlier. The bond side right now is just, it's a little bit nuts, actually. It's been, I think we've had probably about 24 bond deals, particularly in Norway, just in the last 12 months related to energy, anything shipping offshore related. And so it's been a pretty tremendous opportunity if you want to access the bond market today. And Wiley mentioned some of the needs around U.S. companies who, if you want to do a U.S. high yield offering, you need $400 or $500 million, as Ole noted. But you can do these 200, 300 million bond deals in Norway, which many of our clients are taking full advantage of, and some of them are actually 500 million plus, like Yinsun and a couple others. Golar just recently issued 300 million, which they probably could have taken more if they wanted to. So it's a pretty unique time in the market right now. So I'd say right now, everything is going tremendously well, despite the fact that you see so much turmoil going on a macro basis. So that's the part that's a little bit unnerving for me. But I think, as we know in shipping in particular, unfortunately, when you have chaos in the world, that actually seems to benefit shipping. And so we're seeing part of that as well.
Wiley, what are you seeing in terms of the investor base?
Yeah, I think so. It's always illuminating when there's a transaction as opposed to just looking at, in the U.S., the quarterly filings and seeing how things have changed. Ola points out SFL, they do have kind of a unique shareholder base in that it's kind of founder, and then there's some really sticky money, and then there's a mix between long-onlys and hedgies, and there's a bit of retail. What we've seen over the last 10 years is retail's kind of come out of shipping, and really the amount of what so-called or self-reported yield or income funds have come down. It's less than 10% of the market now. In some cases, some quarters less than 5% of the market. And so that's not just the fact that, in recent kind of years you've been able to make 5% of your checking account. That is just, I think, investors thinking about total shareholder return and focusing more on capital appreciation and the underlying businesses. And so we used to use retail as really a tool to fill up a transaction. And now I'd say in the last, for example, the deals we've done this year would be about 9% retail. And then the rest would be probably 40% long only. And long only is fairly narrowly characterized. And then the rest hedge funds, although the hedge funds I would split between faster moving money, and then value-oriented hedge funds who tend to stay in for multiple quarters. So I think on your deal, there was probably 85+% new names there, and what our job was to make sure that those were names that wanted to hold.
Sticky names.
Exactly, and that's the discipline that you have to add. But I would say it's more evenly split. In the other category, they don't come in deals necessarily or often, but is the index funds. And I think there's a lot of companies that have grown to the size where index funds have come in, and that's like super passive capital. Dorian, for example, has a lot of index funds. So it's a more diversified, more grown-up, kind of investor list as an industry now.
Ula, from the
Interesting,
corporate
also to observe the retail shareholder base. So we have, 60 to 70,000 shareholders, which is not so uncommon in the U.S. market. But you see in some Norwegian names like MPC, the container ship company in Oslo. That, of course, on the back of that, of the boom in the container market, I think they now have close to 100,000 shareholders, retail shareholders, out of Oslo, which was unheard of, if you went back like 5 or 10 years. Then that was very much, I would say, private equity hedge fund type investors. They wanted in, double their money, and get out again. So there is some dynamics changing also in that market. And I think also we should maybe also mention, one thing is sort of the size you need to do when you do a deal in the U.S. market, but also the cost and complexity of doing this. And the main reason for that, and raising capital in call it out of Norway, is from a legal fee perspective. You don't like that, Keith, but and other costs. It's a small fraction, and the reason why, it's very simple. It's sort of the Glass-Steagall Act, where after some fraud incidents in the 20s, I believe, or early 30s, we as a company cannot sell to you as an investor. We have to sell to the investment bank, and the investment bank sells to you. So the whole documentation, call it mushrooming, and the complexity has nothing to do with protecting you as investors. It's all about protecting the bank from being sued by you. And then there is no limits to what you can do or what you get lawyers to do to help you protect it. And we end up paying the check for that.
It's always enlightening to get the issuer perspective in a discussion. I appreciate that.
But look this is the guy on the other end there. I mean, he's living off this, aren't you?
Well, listen, we're here to protect you and the banks. So. A few of you had mentioned IPOs before. Everyone's always interested when there's going to be a return to the IPO market. We've seen some smaller IPOs, spin-offs, but we really haven't seen, big IPOs in the U.S. Maybe Wiley, you could talk about what characteristics do we need to see in a company so that there could be an IPO here? Is there some sort of opportunistic window where a company could come to market, or is that market closed?
Yeah, I mean, listen, I think the market's open. I think the bar is higher, and how I would describe that is, we've seen some consolidation of existing public companies, Star, Eagle, for example, and Dry, Frontline. These companies are getting bigger, more investable in terms of market cap and float. And I think if investors are going to take a risk on a new company, it's got to be either priced really well, which is going to factor in the risk of it being relatively small float and being difficult to sell out of, or it has to have some differentiating characteristic relative to the comparable company set. And so what we have right now is a relatively strong peer set in a relatively strong market. And so I think the bar is high both on size. I think you need to be doing $200-300 million deals to get float up, and you need to have market caps kind of closer to $1 billion, or with a near-term path to $1 billion on the market cap size. And I think that you need the wind at your back in terms of your own sector. I think where we may see some exceptions or some kind of episodic IPOs are where we've seen some companies go private, and sponsors now have the option to either take those companies public, sell their stake, or sell the company. And so we're working on processes like that where people are reviewing their strategic alternatives in the private markets, and there's some big enough IPO-able companies there that may come to market. But I think car carriers was an interesting example. Never say never when there's a super cycle, or however you want to name it, vertical, investors can rarely resist the temptation to ride along for a few quarters or whatever runway is on offer. So I think, there's nothing that we can see right now, but there'll be a few catalysts and verticals that'll create idiosyncratic stories, and then there's going to be some companies that have maybe gone dark for a while, changed a little bit, and will come back into the light via IPO.
Wilhelm?
No, I'm going to trust Wiley on his analysis on the U.S. market. But yeah, it makes sense to me what he said. The only thing I can add is that in the Norwegian market, well, I'll already mention it by sort of the peer set being quite crowded, so you need to come across as unique, offering something new. But also what Wiley mentioned, that size has probably become more important also in Norway, in that all the already listed companies have grown in size, become very liquid, and that raises the bar also for newcomers.
This is also the M&A panel, so I think we need to cover some M&A. So basically, I want to understand. We've seen a lot of M&A transactions. We've seen full-scale mergers, big fleet acquisitions. There's been a lot of activity going on. Maybe you guys could touch upon what are the main trends in M&A. Are these trends going to continue? Are we going to see more of the same, or are we going to see a lot less in the near term? Ula, maybe you could talk about it from your corporate perspective on how you view M&A and consolidation and the like.
Yeah, I think the underlying market we're in is a commodity market. Our ships are generally commodity assets, and you can buy and sell ships. You can get crew for those vessels. Internationally, they're typically crewed in the Philippines or somewhere else. So it's very difficult to sort of justify a big premium over those basic values, when you do an M&A transaction, and that's one thing we see. Another thing that's also an observation is that many of the U.S. companies have poison pills, and that poison pills is typically, to protect the companies from hostile takeovers. But in the maritime space, it's not really. I mean, you basically have a little handful of administration staff that may be located here in the U.S. or somewhere else. All the rest is done. All the rest of the work is done effectively on board the vessels or in other hubs. So that is also an obstacle to do M&A. Simply that poison pills basically fend off for the wrong reasons. It's really usually to protect management rather than the investor when they set that up. Interestingly enough, I mean, the companies where John Fredrickson is invested, Frontline, Golden Ocean, Flex, SFL, all of them, there are no poison pills. He just doesn't understand why on earth you need poison pill. These are commodity assets, as we said. If someone else can run them more efficient, someone else should do it. Why should you, if you have run a suboptimal, business, why should you protect yourself when these assets can be run better for the benefit of the shareholders?
Jay?
And that you don't see so much of in Norway. That's more of a U.S. phenomenon.
Yeah.
Jay, what are your thoughts on the trends in consolidation?
I think we touched upon, obviously, a couple of big trades that already happened. So you're seeing these big asset deals. Also the Pangea deal, which, very, very creative deal that they did with the dry bulk fleet from MT Maritime. So that's, again, that was on an NAV to NAV basis, so quite an attractive deal. M&A deals are just hard to do in general, I would say. You got to find a willing buyer and a willing seller, and if you can't find that willing seller, you have to try to do it in a more coercive fashion, which tends to be very expensive or difficult. So I think I almost find take private transactions much easier to do, frankly, than corporate mergers. But it really depends on what the motivation is from both sides. But we're definitely seeing more activity for sure. And I think that, I would hope to see companies getting bigger so they become, as Wiley said, more investable. And I think this is a terrific sector to be in. And so I think we definitely want to see more investors looking at the space. And I think the more larger, sizable companies you have within the various sectors, it hopefully, garners attention from other investors.
Well, it looks like we're running out of time here, but, Wilhelm, Wiley, I want to give you an opportunity to make any final remarks, anything you didn't get a chance to say.
Yeah, just one comment on M&A in shipping. I think the driver is really that asset values and share prices have come up, meaning that some investors who came in years ago and have been sort of waiting to make a profit on their investment finally have the chance to get out with a profit. And the sort of pricing also closer to NAV, which is their ask price in a deal. That is what has sort of led to higher activity. It's not the sort of typical two companies joining forces to create the even better one. It's more one party looking to exit.
Yeah, I would say my quick adds to that would be, I like the fact that there's financial sponsor capital coming into the space, that private equity got totally torched, 10, 12 years ago, and there was just no private bid for companies. Now there is. That tends to start things, or can start things. And then corporate mergers, which are always hard, in part due to social issues, personalities. To Ola's point, in the US, you kind of have to come through the front door as opposed to come in more aggressively. But I do think that the size of companies, again, that bar, whether it's IPOs or just the way they trade or the way they're going to be valued in the public market or the private market, the bar is higher for a larger company. Those attract a bid from big sponsors, and those also get rewarded more favorably in terms of valuation by public investors.
Well, thank you very much, everybody, for a very insightful discussion. Nick, thank you always for hosting a wonderful conference, and don't want to keep anyone from lunch.
Thank you, Keith.